Good morning, everyone. Tim Nyland here. Today is October 21st, and this is our weekly internal strategy call for Zacks Professional Services. Last week, we had a really nice comprehensive call on sector avoidance for top performance, and specifically dove into the issues surrounding what we need to see in terms of trend for a growth-oriented investor to become interested in bank stocks. And what you're seeing on the screen right now is our YouTube channel for these weekly strategy calls. And I would like to say that I could just read off the URL to everyone and they could type it in. But unfortunately, to get access to this, we've sent this out in our weekly email each week. It's located at the very bottom. You can get to the actual history of the webinar. So if you haven't seen this webinar history yet, look for it in the email that you received this video in. It'll be at the very bottom. And if you're still having trouble locating it, please just send us an email and we'll copy the link over for you so you get this view. The reason I'm mentioning this is because I'm going to pick up right where we left off in this discussion about trying to confirm trend on when to actually approach investing in bank stocks. So we've had a lot going on over the past week. We had a little bit of a spike up in jobless claims. Obviously, we had a really nice consumer spending number come out. And I think that's probably had something to do with why Nancy Pelosi and the White House are so anxious to kind of get this next round of stimulus going. Certainly, the consumer spending is obviously what's propping up the economy. And without further stimulus, that's going to be at risk, especially since the COVID numbers are now ticking up, which is interesting. The other thing that's happening that's not getting a whole lot of press, it does a little bit from time to time, is that mortgage rates are at an all-time low, and it's definitely causing a housing resale boom, a refinance boom, and I think that's also being helped by the COVID-related migration out of the cities into the suburbs. So a lot going on. But what I want to do now is focus back in on, as a growth investor, what we're looking for when we actually are looking to make an investment in banks. So again, the signals that would confirm more or less a trend in inflation. And I mentioned the key to this, one of the favorite views that I had, and I'm just going to recircle back again from that webinar we did last week and show my favorite view in the Zacks research system, again, our institutional platform, which is the 30-10 Treasury yield spread analysis. This, again, what you want to see is not only the 10-year rising, but obviously the 30-year rising at an even faster rate. And we want to push the spread between the 30-10 well past its median. 2x would be good as confirmation of a positive sloping yield curve. And that would definitely be good trend confirmation for a growth-oriented investor to want to take a hard look at banks, and even before that. So the key is to continue to watch for the effects of stimulus, right? Pushing up the long end of the yield curve. It's really the long end of the curve now, in other words, the 30-year, that is really, really going to more or less dictate how rapidly, we start seeing inflation. In other words, we're going to have some sort of trigger, and it's going to reflate commodity prices, going to steepen the yield curve. And I guess the question is, how do we get there? And I kind of backed into this theme this week based off of, obviously, Wall Street Journal articles that I'd seen in the journal. And so we'll pick up here with our first article, which is based on the U.S. budget deficit tripling in 2020. And I highlighted one of the more important parts, and it talks about the federal debt totaling 102% of GDP for the first time, right? Federal debt. Note that it's federal debt totaling 102%, exceeded the size of the economy full fiscal year in more than 70 years. Okay, so this is obviously new territory for us. And this is obviously something that could serve as a tremendous catalyst for future inflation. But the interesting thing is it's not the entire story. The remainder of the article is good as well. It just continues to talk about the deficit widening to a record. The real story for us in terms of inflation and investing, and again, to the extent we can get some inflation and we can actually get it to reflect on the long end of the curve, is where we're going to actually see this value rotation start to take hold. Remember, in order for value stocks, including banks and financials, to really begin to rally, we need inflation. We need commodity prices to rise as well as the yield curve to steepen. So in Advisor Tools, I want to more or less expand upon something that wasn't discussed in this article. Now, the real story here is not necessarily just the federal debt totaling 102% of GDP, but when you look at the total public debt as a percent of GDP, we've notched an entirely new level, okay, with COVID. So you can see back here in the 90s, we kind of hit a new level. We came down a little bit in 01. And then obviously the Great Recession, we pushed to another new level of total public debt, not just federal debt. This is total public debt, right? So we were already here public debt wise after the Great Recession at the 102, 105% of GDP level. Now we're up to 135% of GDP. And look, I know that we've been looking for inflation for years and years and years on end. And the question is, is this next stimulus package that Pelosi and the White House are negotiating now, is this going to be the final, more or less, nail in the coffin to get inflation to finally begin to rise? So I just want to call that to everyone's attention. This is the real story. Again, I'm using Advisor Tools here, and we get the St. Louis Fed database through our system, and you can just simply type in this series here and graph it. Interestingly enough, if you open up the library under fundamental chart, you can get it through any of these charting facilities. It's one of our default templates that we actually created some time ago. It's total public debt as a percent of GDP. And it's going to be interesting to watch that chart change to the extent we continue to get more COVID-related stimulus. So keep an eye on that, and also keep your eye on what's going on with these, specifically the 30-10-year spread. We want to see this increasing, but we want to see this increasing not because the 10-year is going down more. We want to see the 10-year rising, the 30-year outpacing that, which would be a really, really nice signal for us in terms of wanting to take a hard look at banks. Okay, so we'll move on to our next topic, and it's related, and it has to do with stocks and bonds implying that cash isn't trash, right? So this article was really interesting because I highlighted the two most important parts. You can see when I saved the file after I scanned it, I actually said cash is not king up here, and that was just kind of a cue to me to say, look, based on what I just talked about with the threat of inflation and the Fed, printing more money and us, stimulating the economy, it's basically making our cash worth less and less each year to the extent we finally do have inflation. So we're in kind of a really interesting spot now. And that's why I'm bringing this article up as a catalyst to have this discussion. I don't think cash is king. This article implies that cash isn't trash, which I think is a true statement as well. And the issue here is that, and I'll just zoom this in so you can see it a little bit better. They're saying that if the 10-year yield goes down to zero, its market value would rise by only an additional 7%. So basically it's saying that treasuries don't really have much more room left for upside, right? So that's the idea behind, the bond market in general, losing its ability to cushion the blow from an equity route. It's just losing that ability. So it's becoming more and more correlated with the equity class of securities, if you will. But the interesting thing here is the flip side too, that if we start getting the economy, they say, really humming here, So that could be based on the stimulus. It could be any number of things, right? The Federal Reserve keeping short-term rates in reserve. So if that pushes yields to the 10-year to 2.5% from where we're at now, the 10-year note would more or less lose 16% of its value. So there's definitely some significant risk to the downside for treasuries to the extent we do get this inflation and we do get the 10-year rising. Banks are obviously going to love it, and so will value stocks. Remember, value stocks need inflation, right? They need inflation. That's the key to understanding the economic cycle and value stocks. So if you take away one thing from this discussion, please remember that. Okay. The other thing related to this, and I know somebody would ask me if we were doing this live, if I say cash isn't king, and I know I've shared my brokerage account with many financial advisors, and they laugh when I show them that I use, the triple Qs and other growth oriented instruments as my cash repository. And the only reason for that is I just it's just a hedge against potential inflation. I know I can get better returns elsewhere. So the idea is, if not treasuries, where do you look to in terms of bonds for yield and appreciation? And my go-to at this point would be in the convertible space, and a lot of the higher quality convertibles, you will notice if you lift the hood, are going to be tied to those growthier oriented names, specifically in the tech sector. So don't shy away from convertible bonds. I think that is really more or less your safe haven at this point. Definitely want to keep a more growth-oriented tilt rolling here, especially with the threat of inflation. You're going to need that appreciation. So that would be my my 2 cents in the summary there. It's that monthly time again. So again, about once a month, we start seeing these articles pop up in the Wall Street Journal. And the fact, over the last week, I saw 2 of them, and this one had the pretty chart. So I went ahead and cut this one out, and I actually drew some lines here with some colors. And we're going to take a look at my my favorite spreadsheets here in just a second after I comment on this article a little bit. My comment on this article is be careful what you read. Look, they show the S&P 500 share of market value by sector here, and they show technology just going absolutely parabolic. There's this little tiny asterisk here. I've got it highlighted. It's not just technology. It's actually tech and communication services. So it's no surprise. When you combine those two, you're sitting right around 35. I guess they're showing right around about 37%, which would be about right. But they should actually put up here technology and communication services, not just technology. But at any rate, they did this. At least they disclosed it. Just be aware of that. You can see what's happening to all the other sectors. Technology, again, is just where the growth is. I've been saying this for literally months, if not years. And it's interesting that they quoted a portfolio manager here from Janice Henderson Investors, and she says that she remains confident in the biggest technology companies because of their reliable growth. And again, that's what I've been saying. It's where the growth is. Do not shy away from this space, even if we have a value rotation. Is it going to come at the expense of technology? Maybe a little bit, but out of the top names, I'm not so sure. This is where the growth is, and I have all of the stats, all the return metrics, the valuation metrics to prove it. So just be advised that I think that the assets are going to come from elsewhere, specifically out of the Treasury market. So we'll see. It could be out of bonds. It could be, the trillions of dollars in cash sitting in the sidelines, people, searching for more growth, more yield. It could come from any number of places. So take that with a grain of salt. And so what I want to do now is just kind of jog everyone's memory. And again, I do this once a month. I'll take us back through August. And where I want you to see is that tech's sway over markets nearing records, it's been at records. This isn't anything new. So this report saying that it's nearing records, I mean, I guess if you're splitting hairs, you could say it's nearing records, but we've literally been at this level now for like 3 or 4 months, and I have the spreadsheets to prove it, at least from the perspective of big tech, the ones that I track specifically. So again, this is basically the S&P 500 spreadsheet that I use to monitor the leadership and the laggards in the S&P 500. It's literally all 500 names by market cap and their price performance since the pandemic. And if we look at the top 5 names from the August 7 print, this is when I did this in August, so we're going to take a 3-month look at this. You can see that Apple represented 6.42% of the S&P, about 5.5 for Microsoft, same thing for Amazon. Google's about 3.5, Facebook's about 2.5, for a total of 23.25% weight of the S&P 500 in 5 names. Now, for our ECP tilts, we obviously added Adobe for many reasons. They can be heard on my webinars. And we basically calculated the top 5 names total market cap. And you can see that it is just shy of 7 trillion. And I mirrored this number by representing the bottom X number of names market cap total. So the top 5 companies in the S&P 500 by market cap on August 7th rolled up to the bottom 370 names, not 369, not 371. It was literally 370 names, okay? And I'm saying that for a reason, because as we roll forward to the September print, it hasn't changed. It still represents the bottom 370 names, not 369, not 371. It's 370. Things have not changed, right? We're sitting at just shy of 7%, 5.2, 5.2, 3.5, roughly 3.5. We're at 2304, a little bit of a rotation. You could call it, up roughly 0.5%. Let's go back there. So that's not even 0.5%. 23.25 to 2304. Okay. Now let's look at the most recent print from 10/19. Okay. And we're right back to where we were in August. And again, it's still the bottom 370 names equaling the top 5 names in market cap. And I want you to look at the price performance of the top 5 names plus Adobe. Okay. We all know that the S&P 500, I think year to date, is up somewhere around 8.9, let's call it 9%. Look at the performance, right? This is literally where all of the performance, the S&P 500 is coming from. These 5 names plus Adobe plus a couple other high beta names in here in the S&P. And if you scroll down to the bottom 370 names again, okay, which we'll do, look at these deep negatives. It's just a sea of red. And so there's still no signs of a true value rotation, right? We'd see it. This morning, there was another call from Morgan Stanley to start paying attention to the equal weighted S&P 500 and shy away from the market weighted S&P 500. Well, if you do that, you are basically unweighting these names and overweighting these names in the hope that this is going to rotate. But if you look at what's going on in the airline industry, we just passed 1 million customers per day in the US. We were at like 2.5 to 3 million customers a day prior to COVID. There hasn't been a sharp rebound. It's just been slowly ticking up a little bit every week. Nothing major. The yield curve is still flat. Fed's still on the sideline. Has anything changed? The answer is no. And so you have to decide as a value investor when to make this leap. Value investors are always going to be in before a growth investor on this rotation. That is by design. That's what value investors do. If you're a value-oriented investor, it's totally fine. Understand that I come from more of the growth perspective, and I'm waiting for these trends to be confirmed before I make any changes. And I think it's still going to be a while. So again, the tilts haven't changed. This genie, as the CEO of Adobe said, is definitely not going back in the bottle. More companies are going to allow permanent work from home for even greater than 50% of their staff. And you'll see a lot of staff rotating in and out of offices, and it's just putting more and more pressure on these big tech companies and communications companies to basically deliver services. So again, it's where the growth is, and I would continue to look towards that leadership for growth of those top S&P 5 names. So that's all I had for today. We'll go ahead and end it here, and we'll pick it up next week. Thank you.